Hello and warm welcome to this, our monthly edition of Econoday Unplugged, Tuesday, 26th of April 2022. Terry Sheehan's on the US East Coast, Max Sato's in British Columbia, Brian Jackson's in Sydney, and I'm Jeremy Hawkins in London. Well, it's clear that many central bankers are becoming increasingly concerned that inflation will remain unacceptably high without a significant additional tightening of policy. In fact, some central banks have already shifted up a gear, favouring more aggressive interest rate hikes as they seek to reach the equilibrium or neutral level of rates that much faster. However, remember that quantitative tightening, passive or active, is also just around the corner in several G7 countries, and no one really knows what the double whammy impact of higher borrowing costs and shrinking central bank balance sheets will actually be. Just last week, the IMF slashed its world growth GDP forecast from 4.4% to 3.6%, while the World Bank cut its to a still lower 3.2% and also said that it would provide an even larger economic support package than it offered to address COVID. Adding Bank of America's new Global Fund Managers survey, which found growth expectations for the next 12 months slumping to a new record low. And it's more than apparent that central banks will need to tread very carefully if their newfound hawkishness isn't going to turn, at best, a probable bumpy landing into a much harder one. So let's kick off with Terry and the US situation. So Terry, the leader in last week's Economist magazine read "The Fed That Failed." Now that may or may not be fair, but with all this talk of larger interest rate hikes, 50 basis points seems pretty well fully priced in for next week's FOMC meeting. Moreover, at least one regional Fed president I noticed said a few days ago that the central bank shouldn't rule out increases of 75 basis points. So what's your assessment of what's really needed?
Well, I think that 75 basis points sounds a bit excessive to me. But I do think that when Jerome Powell was speaking last week, he made it pretty clear that 50 basis points is on the table. And he did not downplay the possibility that there would be a 50 basis point increase. So I think markets are probably pretty safe pricing that in right now. Are they behind the curve? I think Powell came close to admitting that they were, which means I think that we can expect a very aggressive Fed over the next few months, at least until it's clear if the rate hikes are addressing inflation. But as you mentioned, the quantitative tightening aspect of it, several policymakers have mentioned that it is rate hikes and the reduction of the balance sheet that is going to help take the stimulus out of the economy and bring inflation down. So I don't think that a 50 basis point increase is going to necessarily be universally popular among Fed policymakers.
Okay, interesting. Just given how aggressive the pricing is in some of these financial markets at the moment. Let me ask you, since the March meeting, do you think what the Fed regards as the neutral, equilibrium level, call it what you will, for the Fed funds has been increased? And how quickly do you think the Fed actually wants to get there, wherever it might be in the first place?
Well, some policymakers have been saying we need to get to 2.5% by the end of this year. Some think it can be a little bit longer. But I think that 2.5% is the target that most policymakers have in their minds.
And is it a case of front-end loading, or is it going to be a smooth process actually getting there, do you think?
That's a good question. I do think that if we see 50 basis points at this next meeting, it does not guarantee there will be another 50 basis points at the one after that. I do think there's an element of caution creeping in for some policymakers. I think they want to have a little bit of time to gauge the impact of both the March increase and the one that's likely to happen in May. So I would not be surprised if they drop back to a series of 25 basis points for a little while.
Okay, I've got to ask you about the currency markets because there's quite a lot going on there at the moment. In particular, clearly, we're in an extremely strong dollar environment. And with this, the greenback taking off, does that have any implications, do you think, for perhaps a potential tempering of rate hike prospects as we go through the rest of the year? Or is it neither here nor there? It's all about what's happening domestically?
I think, as far as the Fed would say, is that it is about what's going on domestically, and that dollar policy is the purview of the Treasury Secretary. So I think they take into account what it might have an impact, but it is not something that they would try to manipulate in any way or offer any guidance on.
Okay, must be interesting what Max has to say about the yen, given what's going on with dollar yen at the moment as well. All right, let's have a look at some of this week's numbers then, because obviously we get the first look at US first quarter GDP. And I was going to ask you, I mean, do you think that's particularly relevant, or is it almost too historic already, given what's going on elsewhere in the world, in terms of what it might mean for Fed policy?
Well, I think in terms of Fed policy, it will give Powell and his colleagues at the Fed enough justification to say that the US economy is strong enough to withstand a few rate hikes and maintain its expansion. But really, the March numbers are kind of in the rear view at this point. I'm very much wondering what the April employment report is going to look like when we see that. I guess it's May 6th. Right now, all indications are that the labor market is still extremely tight, although it is showing some signs of easing a bit. And inflation is higher and more persistent than the Fed had anticipated. So we'll have to just wait for the April numbers to see if we've seen any immediate impacts or fundamental changes in how the economy is behaving after all the geopolitical events abroad.
Okay, let me ask you also about the GDP, fair enough, but the ECI, so the cost index, will get out on Friday. Do you think in some ways that's going to be more important to how the Fed's analysing inflationary trends and what's generally going on in the US economy than the actual GDP data themselves?
Actually, I think that might be the case this time around, because that's going to give us a really good idea of the nature of wage inflation and, in fact, overall compensation inflation. And it may be bigger than we have seen for quite some time. So that may, in fact, be more relevant to them in combination with things like the CPI, the PPI, and the PCE deflator.
Okay, just well, from my side, the last question I want to ask you in terms of Ukraine, since I've got to ask about that. No, previous podcast, you've kind of intimated that so far, at least touch wood from your side, the impact, at least on the domestic economy, hasn't been that great. But has there been anything since we last spoke to suggest that what's going on in Ukraine is having any impact upon the likes of consumer or business sentiment, which could perhaps hit economic growth as we go forwards?
Right now, the measures of sentiment actually seem to have leveled off, although they are lower than they were. So that part's good. Inflation expectations seem to have leveled off, although they're relatively high, but compared to the historical readings. But that's good. We've got some early surveys of manufacturing and service sector activity. Manufacturing looks like it's going to be a bit slower in April, but service sector activity is actually holding up pretty well. So, so far, the events in Ukraine have not rippled into the US economy more than sort of at the margins.
Okay, interesting stuff. Anything else you'd like to put in from your side before we move across to Max?
No, I think we're ready to hear from Max.
Okay, excellent. Right, Mr. Sato, over to you then. So Max, from what I've seen, economic activity in Canada has been outperforming expectations, the best part of a couple of months now. You've got inflation at a 3-decade high, and a Bank of Canada who appears to be sounding increasingly hawkish. They've already stepped up their pace of tightening to 50 basis points earlier on this month. And I read somewhere that was growing speculation, at least from one national, from the local bank, I should say, that it could be even a 1 percentage point hike coming up too soon. Do you think that's really realistic?
I would say 50 basis point hike is already priced in, and the BOC people seem to be dying to sort of catch up and remove the excess monetary stimulation. So, but at the same time, I don't think there's a kind of a need to jack up by 1 percentage point. So the reason being that at the start of the pandemic, March 2020, they cut the key interest rate target by 50 basis, actually 350 basis points in 1 month to a record 0.25. So that's that they want to unwind. I would say a more traditional, safer ways to go 50-50, 50 or 50-50 and 25-25, or they seem to be trying to move the rate up to more neutral level.
Okay, right. That takes us then to the neutral level. I guess we're looking at all these markets at the moment. The two key questions are: one, how aggressive do central banks want to be, and two, where are these interest rates going to peak out? So, is it still the case, as I understand? I think the last time I saw it, the Bank of Canada was talking about the neutral interest rate estimate be somewhere between 2% and 3%. And if that's the case, do you think they want to get there smoothly, or I was asking Terry a short while ago, they want to perhaps front end load this and then so we get most of it out the way and see how much they need to do later on in case they don't actually need to do it?
I would argue that this is an extraordinary situation. In normal circumstances, if the central bank says, okay, we're going to jack up interest rates, and people will worry about it, and whether it's for financing home buying or autos. But right now, extremely high consumer inflation is also a problem for people's purchasing power and business producing costs. So actually, for the bank to raise interest rates, they're not really in a normal sense of hurting the economy. They're trying to solve one big issue of too high of a cost for everybody.
Okay, that's interesting. I guess if you pull it all together, by and large, the Canadian economy is still doing pretty well. We'll get the February GDP report out this week, remember, on Friday, which I guess is going to be a pretty strong number.
I think so. I don't see a particular weakness so far. Maybe an early indication of slight slowdown in the housing activity because of higher mortgage rates and even higher rates coming up. But for now, if you look at the past records, basically GDP is we're talking about the earlier economic performance. I don't think there's any weakness in there.
Okay, well, that's good to know. And I'm going to ask you too about quantitative tightening. Terry was intimating that, particularly from the state side, folks are now starting to look at the potential implications of quantitative tightening, which, let's be honest, at the end of the day, we don't really know what that's going to be. But from your side, at least from the Canadian side, I should say, we're now at that stage, aren't we, whereby we're into kind of passive tightening, whereby the Bank of Canada is not reinvesting maturing assets on its balance sheet. How far do you think we are from where they actually start active tightening? So we're talking about outright asset sales.
They already said they're going to start quantitative tightening, and judging from the comments, they're not too worried about the effect on the economy or financial markets because it's a small economy, open economy, and they didn't do extreme easing like the Bank of Japan has been doing, like introducing negative interest rates or whole yield curve control. So, and also the purchases sort of skewed to shorter maturities. So they're not really concerned about the negative impact of quantitative tightening because it's more of unwinding of easing.
Okay, and I guess that's true for a lot of central banks, really. And when you think about how low interest rates are, it's kind of getting back to some kind of normality. The problem being, what does normality actually mean these days? Okay, thanks. Anything else you want to add on Canada before we move across to Japan?
I think that's about it.
Right, and let me dig your brains then on Japan. I've got to start off the exchange rate. We've had dollar yen recently trading, at least last week, above what 129 to the dollar over the last few days, or its highest level in some 2 decades. Now, we've got a Bank of Japan meeting at the end of this week. So is the central bank concerned about dollar yen? I mean, in the past, we've kind of assumed that dollar yen doesn't do a great deal anymore, but clearly it's been, by recent standards anyway, extremely volatile of late. So do you think there's any kind of chance of a shift in the BOJ's target range for the 10-year JGB, or indeed do you think they might actually change the forward guidance on what they're saying about interest rates?
I don't think so, because first of all, it's really a risky argument to sort of link the current nominal exchange rates to what the bank should do in setting interest rates or asset purchases targets. And while the CPI, we're going to see a preview to the national figure in the Tokyo CPI during the Golden Week holidays, that's May 6th. We're going to be probably seeing total core, especially total CPI close to 2% annual rate, just because daily necessity prices keep going up, and the base effect of the huge mobile phone usage fees from last April will disappear now. So that's only a temporary phenomena, and nobody in Japan thinks that the 2% inflation will be anchored anytime soon. So in that sense, since the yield curve control and more flexible asset purchases closely linked to the achievement of the 2% target, which was agreed between the Bank of Japan and the government back in January 2013, when just after Shinzo Abe brought LDP back to power. So unless that basic framework, policy framework agreement between the government and BOJ is revised maybe later on next year in a review, if it ever happens, I don't think bank can really change the main targets, which is around minus 0.1 for the short end, and 0 or 0.25 percentage point either side for the 10-year JGB yield. This is also because about a year ago, March last year, they made a huge review and introduced some adjustments to what they do in asset purchases and allowing market rates to move more in a wider range. So unless they do another step of a official review of the framework, I don't think it's possible for them to move in a major way in policy setting.
Okay, that's a fair answer. I've got to ask you, let's suppose we see dollar yen next week going up to 135. Do you think there'll be any chance of BOJ intervention?
It's all up to the Ministry of Finance to decide in close contact with a Treasury.
Right.
And the risk of intervening, I might have argued before, is it's not like printing yen as much as they want, but they have to use the foreign reserves. And as you can recall, Mr. Yen Sakakibara said recently that he thought that it's a little bit a scary moment in the late 90s because they had to use a limited gunpowder to step in against the strong trend of a rising dollar.
Interesting, but I guess, of course, slightly difference in Japan's case in the sense that they could actually do with some inflation opposed to most of the rest of the world, where it's far too high already. Okay, thanks for that, Max. Anything else from your side?
Yes, just comparing Canada and Japan, I thought it was interesting to call up this Bank of Canada governor's opening statement to House of Commons Standing Committee on Finance. He's talking about the Canadian economy going forward, and he said robust business investment, improved labor productivity, and higher immigration should help boost the economy's productive capacity. This is true with North America, but if you talk about Japan, basically there is no immigration. They're really strict about letting people in.
Right. Yeah.
So dynamic shift towards growth is not really there. And also, if you have to rely on consumer spending, which accounts for 55% of GDP, you can't really expect too much because there's this wealth preference, people saving and investing maybe more, and that has sort of become a purpose and sort of the means to financing something.
Okay, interesting stuff. Thanks for that, Max.
Okay.
Right, well, let's start moving south and towards Brian, and in particular China, where things don't appear to be panning out perhaps quite as the government planned, particularly as General Secretary Xi Jinping pushes for an unprecedented third term in office. So, Brian, I know you talked before about this zero COVID policy, and clearly it's been a factor pushing up prices. But now with this mass testing apparently taking place in Beijing, it's clearly adding to worries about global growth as well. So, I mean, what do you think is really going on, and is there any chance of a shift in Chinese policy?
Well, I mean, unfortunately, there's not a lot of transparency about what they're thinking and planning to do, and not a lot of communication about what would prompt a change in their approach. So it's all a bit opaque at the moment, and I guess the only thing we can rely on is what the data is showing about what the impact is, and obviously, if that impact does look set to get worse, then that might prompt authorities to reconsider the approach. But at the moment, that they do seem very very committed to continuing with these very tight health restrictions, and try and offset the impact through some at this stage still pretty moderate policy measures.
I saw, I know one of the banks suggesting the other day that just due to the lockdown in Shanghai, it's potentially already wiped out the best part of 2% of China's GDP growth already this year.
Yeah.
I don't know if, I'm sorry, I was going to ask you, does that seem plausible? And stemming from that, I mean, the 5% growth target they have for 2022, I mean, A, do you think, is that still plausible? And if it's not, is that going to become a risk for the for the government?
Well, it's definitely going to take a big whack off that number. We'll get the PMI numbers next week, which will I think show some of that impact, and then it's just a matter of waiting to see what the official numbers show. But I think it's inevitable that you can't shut down a city like Shanghai and not expect to see a significant impact on the GDP numbers for the whole economy. So whether that forces a change, I don't know. It's obviously they've got some policy tools up their sleeves. They've been cutting bank reserve requirements. They can lower the loan prime rate. They can boost infrastructure spending, do some other fiscal measures. So they do have tools at their disposal, but it's not, I think, going to be enough to prevent a significant impact for the growth numbers.
Yeah, that's going to be implications, I think, for ultimately it may well have some kind of saying what happens to global interest rates if people really do start to think that China's slowing down significantly. And on that side,
and of course, it's very much at odds with the rest of the regional trend. Everywhere else, we are seeing this growing momentum towards tightening policy.
So I'm going to watch on that front. Then was it where are in the case of the last few days, the last week, China's 10-year bond yield falling below their US counterparts for the first time in over a decade. So the Chinese currency's just had its worst week since 2015, if I remember rightly. So I mean, is the central bank got any concerns about what's going on in the currency markets? You mentioned we saw a sort of cut in FX deposit reserve ratios. Was it yesterday, if I remember rightly? Are they getting concerned now about their currency getting too weak and becoming too unstable, and what that means? Because we've had all this talk of late about China pushing for the renminbi yuan to become, increasingly a reserve currency. The lack of stability there now. Has that got any implications for how they're thinking out there, or do they just see it as a short-term blip?
I think there's definitely different time horizons at play here. So, their longer term goals, I think, are still intact, and they definitely want to see the Chinese currency have a bigger role. But in the short term, a weaker currency obviously will help their exporters to a certain extent. So that might be a bit of a benefit for them. But it's not going to, I think, derail their longer term plans. But I don't think that's their main issue at the moment. They've got a lot on their plate, obviously, and if they can just try and offset the economic impact of these public health restrictions, then I think they'll be quite welcoming of anything that can help do that.
Interesting, gotta say, all eyes on China at the moment. But let's move on then to your home part of the world in Australia. RBA next week. As we talked on previous podcasts, I guess we're looking around the world for central banks which seem extremely reluctant to come out and raise interest rates, and the RBA has certainly been one of them. But we'll get an inflation figure out later on today, or well, New York time anyway, I guess tomorrow morning your time. Is that going to be enough, given the fact that the RBA seems at least to be getting rather, let's say, less dovish, if not more hawkish anyway, that it could actually force them to do something in interest rates sooner rather than later?
That is the big question, and
that's why I asked it. We like to be on top of it.
Everyone in Sydney is very closely watching that number, which will drop in just a few hours' time. It's expecting to show a big spike in headline inflation, stronger underlying inflation pressures. So obviously, the first question people will be asking is what does this mean for the RBA next week? The other issue, though, of course, is that we are right in the middle of an election campaign here in Australia that is due for May 21st. So we do have an unwritten rule that the RBA does not move interest rates during election campaigns. It's not really a rule; it's more a convention. The last time the RBA did move interest rates during election campaign was back in 2007. That was when the incumbent Conservative Party was defeated a couple of weeks later after that rate hike. And so we're in a similar situation now where we have long-term incumbent Conservative Party behind in the polls, and some question about whether that will influence the RBA's thinking. They obviously say that it doesn't, that they just look at the economic numbers. But it's really a perfect storm for them at the moment. You've got these inflation pressures, you've got the election campaign, and you've also got their prior statements about what will influence their decision to raise rates. The only thing I think that might overshadow the inflation numbers is that we're expecting the wage price index after the meeting in May. So that's going to be coming out on the May 18th. So I think they do have a reasonable case to argue that we're going to not just look at the inflation numbers, but we're going to wait for the wage numbers after our next meeting, and that could give them good cover to say, okay, we're not going to raise rates next week. It might be the month after, which will conveniently take place after the election.
Because they've been plugging this sort of sustainability of an increase in wages for a long time, haven't they?
They've been saying, okay, the criteria that we are looking at are wages, and so they've been saying that consistently for months now. So there is I think a case for them to say, okay, we're not going to move policy next week. We're going to wait for the following month, by which time we will have those wage numbers for that quarter.
Okay, brilliant. Let me quickly Cross the water then to New Zealand. 50 basis point hike. Where are we? Well, April the 12th from the RBNZ. Looks like they're again looking for a faster move to some kind of neutral stance. Is it still more of the same out of the Reserve Bank of Kiwi, or is there a possibility that things might slow down a little bit and markets getting too aggressive? Or is it kind of like I'll do one of a number of central banks now, given the pressures that they're almost coming under just due to where the markets are pricing things, where it's almost forcing them into some kind of like predetermined profile for interest rate hikes, which can't be a good thing. So what's happening in a nutshell in terms of the Reserve Bank of New Zealand?
Yeah, I don't think they necessarily feel pressured by the market to move at a pace that they don't think is appropriate. I think they've got a pretty good track record of adjusting policy according to the right reasons, and so I think they're pretty comfortable with the pace that they've been setting. They went 25 basis points, I think 3 meetings in a row. Then they bumped that up to 50 basis points earlier this month. I think that they haven't finished, and their statement made that pretty clear that they think there's more to go, and it seems like they're quite happy to sort of continue moving on in that sort of 25, 50 basis point that sort of pace. I think in the next 2 or 3 meetings, that we'll definitely see some more rate increases, and then they'll continually reevaluate based on whether we do start to see inflation pressures come off as a result of this tightening that has now been going on for about 6 months.
Right. Okay. Fair enough. Anything else from your part of the world, or at least the countries you like to cover?
Yeah, well, I mean, as I said, I think we're definitely getting more momentum towards the tightening stage of the cycle in this part of the world. The RBA it has adjusted its forward guidance to open up the door to some move in the next few months, whether it's next week or the June, July, but sometime pretty soon. And we've also seen that with the Reserve Bank of India. They didn't raise rates at their last meeting, but they definitely did adjust the language in their statement to say that they're now focusing on the withdrawal of policy stimulus, which is new language. And so again, that's opening the door for them to make a move going forward at some stage in the next few months. Meanwhile, Bank of Korea, they're continuing on with the rate hikes, and also in Singapore, we've had a tightening of policy there with an adjustment to the exchange rate target. So outside of China, the moves right across the region are in that direction.
Yeah, all up in your part of the world bar China. Okay, thanks for that, Brian. Right, let's round it off then with Europe. Eurozone first, I guess, then. Well, in terms of the economy, I guess it's doing, well, kind of okay at best. We like to look at the economic consensus diversion index over here at Econoday. That currently stands at a healthy 39, meaning that in general, the economy is actually outperforming, currently outperforming expectations anyway. But it had been negative pretty well throughout March. So by and large, the economy has been somewhat underperforming most of the market forecasters. But at the same time, of course, as we've seen pretty well in the rest of the world, apart from perhaps the likes of China and a few other countries, inflation remains well above what the central bank would like to see. The April numbers coming in at 7.4% on headline basis, the core at 2.9 versus the ECB's medium-term 2% target. So consequently then, ECB pretty well crawling towards an interest rate hike. The April 14th meeting came with no big surprises. There's no changes in interest rates, no changes in quantitative easing, more importantly, and no clear indication of when rates might go up. Bear in mind that we still need to have an end to the quantitative easing program before we actually get to the stage whereby rates can actually begin to move in an upwards direction. However, Christine Lagarde, who's been one of the, if you like, the mega horts, the ECB president, she came out the back end of last week and actually admitted that quantitative easing was likely to end early in the third quarter, which is quite a strong statement by her standards, and indeed suggested that there was a strong chance of interest rates rising in 2022, which is extremely strong by her standards. Now, we've certainly got members on the governing council at the ECB who would like to see a 50 basis point point increase in the course of the next few months. Notably, the likes of Austria, the Austria Central Bank governor has been calling for 50 basis points for a while now. We won't get the next meeting until June the 9th, but at long last, it does look as if the ECB is starting to sow the seeds of some kind of monetary tightening. So we've got to get rid of the quantitative easing first, but it does look as if that will be out of the way by the end of June. So we could see a rate hike out of the ECB as early as July, possibly August time, but certainly it seems in the third quarter anyway. Now, don't expect too much. It'll be a big shock to the system because we've had interest rates across the Eurozone so low for so long. But nonetheless, it does look as if we'll see something like perhaps a 10 or 20 basis point increase coming through, which for them would be a big move. Nonetheless, of course, that's going to still leave interest rate differentials between the Eurozone and the likes of US dollar continuing to widen as we go through the rest of 2022. So pulling what everyone's been saying together so far, it still looks as if we're in a pretty bullish dollar environment. What else can we say? Well, in terms of the impact of Ukraine, it's still very much early days yet, but there's certainly some indications that there's been an impact, particularly on consumer confidence and business confidence. The April data, if anything, have held up perhaps a little bit better than expected, but bear in mind that the sanctions have really got to bite yet, haven't actually started properly. And indeed, currently the EU is still buying Russian oil and gas, despite plans to phase out at least oil prices anyway by the back end of this year. Now, crucially, Germany is still at this stage refusing a ban on natural gas, and that's really just due to its potential impact on the German economy. The Bundesbank came out last week, and if you believe its numbers, then an immediate ban from the EU on Russian gas imports would cost Germany the best part of 165 billion euros in lost output this year. That would equate with a reduction in gross domestic product of about 5% or so, and that would imply one of the deepest recessions we would have had in Germany in recent decades. So it's no great surprise that at this stage anyway, as much as the continental Europe would like to see an end to the war in Ukraine, there's a number of EU member countries who are still very cautious about actually cutting off the supply of energy from Russia, given how important it is to them in a hurry. So by and large then out of Europe, not too much really fresh to talk about from last time. I should just quickly mention the French general elections, or presidential election I should say, the round 2 which took place last Sunday. Easy win for President Macron, which was pretty well predicted in the polls. In fact, it easily outstripped the polls at the end of the day. So financial markets, if anything, took that with a bit of a leap because there was, at least as far as they were concerned anyway, a risk that we could see Marine Le Pen, the leader of the French, what you used to call the National Front, effectively, far right-wing party out there winning, and her policy would have been to pull France out of NATO, and indeed increase or make closer her ties with Russia. So as far as investors are concerned, small plus there for the euro, but certainly not overriding what we're seeing is happening in the interest rates market at the moment. In terms of the UK then, what do we got? Well, real economy ECDI for the UK's really underlines, I suppose, some of the problems that the Bank of England is facing at the moment. It currently stands now at -59, which effectively means that UK economic activity, or real economic activity in general, has been underperforming market expectations by just about the most it has ever done since we started putting this little index together. It's the second lowest on record, and really does underline the fact that perhaps the impact from Ukraine, at least as far as UK is concerned, being significantly more than expected. First quarter GDP still looks as if it'll appear okay, but that's only because January was a particularly strong month when we saw growth, monthly growth rising by 0.8%. Since then, we've seen only a 0.1% increase in February, and early evidence is that March isn't shaping up too well either. Retail sales fell 1.4% on the month in March. It really does seem increasingly now that the consumer sector for the UK is being hit now by the sharp increase we've had in prices. In addition to which, of course, in the UK, we've already had interest rate increases. We've got tax rises coming through as well. So there's a fair amount of budget squeezing going on as far as households concerned. And that's certainly stoking up worries about performance or possible performance for the UK in the second quarter, where some forecasts now are actually coming out suggesting that we get negative growth. Indeed, if you just look at what the IMF is saying as a result of their forecasts, their updated ones which came out last week, they slashed UK growth from 2.3% to 1.2% for 2023. That means rather than being the strongest performing country amongst that group in 2023, UK is now expected to be the weakest amongst the major advanced economies. But next year, inflation in the UK is only expected, I believe the IMF, to average 5.3% compared to falls down to 2.9% in the US and 2.3% in the Eurozone. So lob all that little lot together, you've got over the top inflation, which is coming down too slowly, the economy, which apparently is potentially in danger of falling into recession. So it makes for a right messy picture for the Bank of England next week. What will happen then? Well, from the way the participants on the MPC are talking, it still seems very likely that we will get a fourth consecutive interest rate increase in the UK. That will be on Thursday week. Has been some talk we could get as much as a 50 basis points, a la the likes of Canada of late, and indeed the RBNZ. But it still seems, I think, on the whole, that by and large, the bank's still cautious about trying to tread this very fine line between combating inflation but preventing a recession. So personally, I reckon we'll only get away with a 25 basis point increase. Nonetheless, excuse me, that would put bank rate up at 1%. That's important because it really opens a door to active quantitative tightening. Now, by that, we mean that rather than just the passive tightening, quantitative tightening we've had for some central banks, like the B of E already, and the Bank of Canada, whereby assets they're just allowed to roll off the balance sheet as they mature. This would actually mean the Bank of England coming out and selling assets before they mature, so directly absorbing liquidity from the markets. Now, that is the threshold for that is 1% for bank rate, which they very much expected to be reached next week. But it may not happen as soon as next week. This is just a threshold. It's not an automatic trigger. And indeed, from the way some of these financial markets are being strained at the moment, when looking at spreads between bid and offer rates and so on, it seems quite likely that they're going to want to wait a little bit before they actually start going out and doing that. So chances are we've got passive quantitative tightening at the moment. Active tightening, quantitative tightening will probably, I suspect, have to wait a little while. But it'll certainly something which will add to the tightening process for the Bank of England, which ultimately should help to keep the lid, or at least reduce the lid, I should say, on just how far interest rates over here are going to go up. In terms of how far they're going to go, well, the B of E used to maintain in the days of Mark Carney that the so-called R-star measure, the real equilibrium level of interest rates, was estimated at about 0.5%. So if we add back the 2% inflation target, that will give you a nominal target of 2.5%. Now, however, the Bank of England just maintains that, well, we can't really say what it is because it's changing all the time. But markets, financial markets, probably looking at something like that kind of measure anyway. And indeed, financial markets currently are looking for bank rate to be around about 2% or a little bit higher by the end of this year anyway. What else can I say? Well, labour market's still doing very well. Inflation's still going up. So really, B of E, a bit like a lot of other central banks at the moment, struggling what do you do when the economy is slowing and inflation is continuing to rise. Okay, that's enough from the European side. Before we round up, anybody else got anything they'd like to chip into the pot before we finish? Take that as a death-defying no, which is excellent. Or is there?
The pot's already pretty full.
Okay, that's it then. So let's wind it up there then. So I guess what we can say, well, it seems that even most of the central banks that have so far resisted raising interest rates, or at least moving in the direction of actually doing that, and many others now appear to favour the front-end loading of hikes. So kind of implies that there's some fairly sharp increases in borrowing costs to come through over the next few months. Combine that with quantitative tightening, and it may mean that we yet see inflation and growth decelerate more quickly than generally expected, especially if, and there is a big if, of course, the war in Ukraine can be ended soon. Crucially, though, uncertainty levels remain as high as ever, so make sure you keep yourselves fully informed with all the major economic data, policy moves, and other key market moving events in Econoday's global economic calendar. On behalf of Terry, Max, Bron, and myself, thanks as always for listening. We hope to see you again next time. Bye for now.